Okay, so that's what you do about that fair value adjustment. So this figure will be taken to the consolidated statement of financial position and you add it to the non-current assets. That is if it is an upward what? Fair value adjustment. But if it's a downward fair value adjustment, you subtract. Now this depreciation figure you are calculating here, if you are preparing statement of consolidated statement of financial performance, then this depreciation here will be added to what? Cost of sales, because it has to increase what? Your cost of sales. That's the idea about that.
So if it's reducing, it means that the depreciation over here will subtract it
from the cost of sales, so that the cost of sales should be reduced.
And the consolidated balance sheet is what we also subtract.
We will also subtract this figure there. I get it. Fair value adjustment. If it is, I said if it is upward fair value adjustment, then this figure you get here, which is the value minus the depreciation you calculated, the figure you get here, you will add it to the non-current asset if you are preparing consolidated statement of financial position. Then this depreciation figure has to be added to cost of sales because it will increase what? The depreciation that they are supposed to have charged. But if it is a downward thing, then you go and subtract this input. Then this one will also be subtracted from what? Cost of sales. Because that means they have charged more depreciation than what they are supposed to have charged. Sounds good? So that is about the fair value adjustment. Then there are other things that the examiner will bring. I don't know, but he can bring other things. Any other thing he brings, you can deal with it, like prior period adjustment, PPA. Okay? Maybe in the financial statement, they capitalized something last year. But when we apply them, we realize that the thing they capitalized, they can't capitalize it. So we subtract it. So usually, prior period adjustments are at the date of acquisition. There is nothing at the end. So when we finish, we add all up. My space is gone, unfortunately. So we add all up. So we get a total at acquisition, total at year end. Then we find the difference between the total at acquisition and total at year end. That gives us the growth or decline. In other words, that gives us what we call the post-acquisition profit or post-acquisition what? Loss. Note, the net assets at the date of acquisition will be used in the calculation of what? Goodwill. Then this growth or decline will be used in the calculation of group retained earnings and also non-controlling interest. So that is what you have to understand in relation to that. So you have your group structure, you have the net assets of the sub, then you can now go to goodwill. So in heading to goodwill, how do we calculate goodwill? Simple. We're going to bring consideration transferred . Then we bring NCI, fair value of NCI. This is fair value of consideration. And that gives us the fair value of the entire business. Then we bring you less the net assets at acquisition, this figure, the total here, you less it. If there is any impairment on goodwill during the period, you subtract that, and then you will get what? The goodwill figure to be taken to the consolidated statement of financial position. But how do we calculate consideration transferred and how do we calculate NCI? So let's look at that. There are three components that could be included in the calculation of fair value of consideration transferred. Three components. One, so consideration transferred. The first thing is cash consideration. Usually the cash consideration is how much we are paying now at the date of acquisition. So for instance, if Yapa PLC acquires 4,000 shares of 4,000 shares of the 7,000 shares of Rapper at $1.5 per share, that is what we mean, the cash consideration. That could be the first component of the total consideration transfer that you are bringing here. Second, there could be what we call deferred payments. This is how much money you intend to pay in the future. Now, since it is how much money you intend to pay in the future, you're going to be finding the present value of that future payment. And you add that to the cash consideration. Okay? Now, anytime there is deferred payment, you have to unwind it to find about the interest component of it. So the interest will be this present value figure times the company's cost of capital, KE. So that's the second thing that you need to understand about the consideration transfer. Now, how do you treat this interest? When you're preparing statement of financial position, this interest will be subtracted from group retained earnings. But if you're preparing statement of financial performance, this interest will be added to the interest as the total expenses for the period. So you got to see the difference there. You got to see the difference there. That's the second component.
So the interest will be added if it were.
Will be added to interest or will be subtracted from. Yes, will be added to interest when we are preparing statement of financial performance. But the position, we will subtract it from group retained earnings. Subtract from group retained earnings because that's an expenses. Add it to expenses because it's an expenses. Right? So that is the idea.
When you subtract it from the consideration, the calculation you are going to.
No, you don't subtract. Which one? The interest. No, you don't subtract it from it.
So you add it.
The present value figure, you add it to the cash you have paid.
What about the interest?
The interest there, the treatment is in two. If it is co you are doing, you subtract it from this. If it is pair, then you add it to expenses. The PO is the statement of financial performance, balance sheet. And then the pair is statement of financial position. Statement of financial performance, that's PO, balance sheet. And this is statement of financial position, income statement. So that is it about that. Are you getting it? So the interest, if you are doing PO, balance sheet, you subtract it from group retained earnings. But if you are doing income statement, you add it to what? Expenses. Then the third component is share exchange. So sometimes we could make a cash consideration, then we are doing a share exchange. So let me build up on my question. In addition, Yapa PLC makes 2 new shares for 5 shares acquired. So that is a share exchange effect. Now, please note this for me very carefully. Anytime there is a share exchange, we're going to use the share price of the parent company in the calculating of the value. Why? Because it is the parent company that is doing the share exchange, that is doing the share issue. So let me say that Yapa, which is the parent company in this case, has a share price of 2.1. So how do we get a share exchange? So the share exchange value, SE, will be equal to, how many shares did we acquire? 4,000. So for the 4,000 we acquire, we are giving them 2 new shares for every 5 acquired. So that is going to be 4,000 over 5 times what? 2. Then we multiply this result by our share capital, the parent company, 2.1. So you realize that in the cash consideration, we are using the share price of the subsidiary company. But in the share exchange, we are using the share price of the parent company. So what do we get arithmetically? 3367. So this is what will be added up. So these are the three components that may be included in the fair value of consideration transfer. Any question on that? Apart from the consideration transfer, the second animal in the kingdom we are having there of goodwill is non-controlling interest. Yeah?
The KE is the rate of...
Yeah, the rate. Maybe it's 12%. So, whatever thing they give us. Are you okay? So that's what we do. How do we calculate NCI? When it comes to NCI also, there are three ways we calculate NCI, non-controlling interest. So you have to listen to the question to distinguish between which of the three ways the examiner is asking you about. But it's only one of them that will be present in a question. 3. So, NCI valuation. 1. NCI can be valued as a proportionate of the net assets, of the subsidiary at acquisition. What does that mean? It means if we have 70% shares, then the NCI will be what? 30%. So to get the NCI, to get fair value of NCI, it is just going to be their percentage of ownership times what? The net assets of the sub. That's the first way we value NCI. So their percentage of ownership times the net assets of the subsidiary. So you have to listen. Is this what the examiner said? Second, we can value NCI.
Times what? Net asset.
Yes, net asset of the subsidiary. We can value NCI at fair value of the share price of the subsidiary. What does that mean? Simple. This is where we say fair value of NCI is simply equal to the number of shares that the NCI owes times the market value per share. Number of shares the NCI owns times the market value per share. Remember, the market value per share you are bringing here is for the subsidiary. Very, very important, for the subsidiary. So if I'm using my illustration here, if we have acquired 4,000, then NCI share is how much? Or how many? 3,000. So if I want to get a fair value of NCI here, it will be 3,000 shares times the market value of the subsidiary's company, $1.5. And that gives me the value of NCI. So that is the second way NCI can be valued. Third. The third way is at fair value according to the parent company. Very simple. So this is where you don't have to do any workings. The examiner will just tell you that the directors of the parent company says that the fair value of the NCI should be 40 million. So there you don't do any calculations. You just pick that figure that he has given to you and then you go away in relation to that. So these are the three ways, various ways through which NCI can be valued. 3 ways through which NCI can be valued. Now, 3 will not be there. It's only 1 that will be there. So listen to what the examiner will say. If he says this, you don't do any workings, you just pick it up, go there. But if he says this one, you need to do workings. If he says this, you also have to do workers. That is how you calculate goodwill, and as you can see our numbering, that's the third step. So first, group structure. Second, net asset. Third, goodwill. Any questions, please?
So with the deferred amount, in the consideration, first, when you first get the interest, right? The interest, you also calculate on unwinding.
That's the interest. The unwinding is the interest.
Oh, it's the same as that.
Yeah. The unwinding is the same as the interest. Are you getting it? Now there was a statement about that deferred payment that I didn't make. That deferred payment, since you are making the payments in the future, maybe in 2 years' time, that present value will go to liabilities. Are you getting it?
Yeah.
That present value will go to liability. Then you will add that interest you charge for that year to it in the balance sheet. So that is how it is accounted for in relation to that. Now when we do goodwill, we are done. Now we can look at other areas. One thing I didn't talk about when I was talking about the net asset of the subsidiary stage 2 is intergroup trading. So before I come to group retained earnings, let me talk about that. So when we talk about intergroup trading, what do we mean by that, intergroup trading? This is where the parent is selling goods to us, the subsidiary. Please note, if there is intergroup trading and you are preparing statement of financial performance, that is the income statement, then you need to cancel out every intergroup trading. How do you do that? You subtract the sales from the sales, and then you subtract the cost from what? The cost. Very, very important. So where there is intergroup trading between the partners, between the parents and the sub, when you are preparing statement of financial performance, you need to subtract it from cost of sales and subtract it from the revenue. That same figure. But when you are preparing the statement of financial position, then the dealing with intergroup trading becomes a bit different in the sense that you would have to find out the provision for unrealized profit. Remember, even if you are preparing the income statement also, you have to find the provision for unrealized profit. This is where either the parent or the sub has sold to one another, but there are some of the goods that are outstanding. They are still there. They've not sold them. Since they've not sold them, we do provision for unrealized profit. How do you treat that provision for unrealized profit? One, if the parent was the one who sold to the sub, then provision for unrealized profit will go to group retained earnings. Subtract it. Then it will also go to the current, it will go to the statement of financial performance, position, and the inventory as what? Another subtraction in relation to that. So that is how we deal with the provision for realized profit. This is if the parent sold. But if the sub was the one who sold, then the provision for realized profit figure, the net asset schedule I did, we would have brought PUP and it will come at the end of the year as a subtraction. So that is what we have to understand in relation to provision for unrealized profit. So once we get rid of the provision for unrealized profit, another thing about intergroup trading is dealing with cash in transit. Cash in transit. So cash in transit is where, let's say for instance, so I'm going to use an illustration to show that. So cash in transit. So let's say for instance, this is the parent, this is the sub. So look at it. The parent is the one who sold the goods to the sub. So in the parent's books, they are thinking that the sub owes them 1,500. But in the sub's book, they are also thinking that they owe them only 700. Why? Because they have transferred 800 cash, but the parent company has not received the money yet. It is called cash in transit. When there is cash in transit, what we do is that we will force the money into the account of the company that is receiving it. In other words, this cash in transit will be added to the cash when we are preparing what? The consolidated statement of financial position will be added. Now, when it is added, look at what is happening. The parent will have this 1,005 as part of its what? Trade receivables. And then the subsidiary will have the 700 as part of its trade payables. Now, if we force this money into this guy's account, that means that right now, this guy will also owe this guy only what? 700. So these people will now have 700, and these people will also have what? 700. How do we do this? When you are preparing the trade receivables, you subtract the 700 from it. When you get to trade payable, you subtract that same what? 700. Why? Because we need to cancel out intergroup trading. Nobody should owe anybody in the group because we are a single entity. Why should someone owe someone? Can you owe yourself?
But the cash of 800, you recognize.
You add it to the cash.
But that one too, he was expecting it from, or that one he wasn't expecting it from the subsidiary, he was expecting from someone else.
No, from the staff. From the staff, so they've not received it yet. So we force it into their account. That's why we add it to cash or bank.
So if I'm expecting 1,500 from my staff, right, and the person is bringing me 800.
Now the person owes you 700, and it confirms with the figure that they are also having at their trade payable as they owe you.
Wait, so you cancel out that?
Yes.
But the 800, I still got it for myself. So
yes.
It means there was some sort of.
But that one, there is no deal. It's only things that are outstanding. So that is why PUP, we are not doing provision for realized profit on the whole sales figure, but only for the goods that are outstanding as at the year end. So now that you get this out about intergroup trading, then you can now deal with the group retained earnings. So group retained earnings, and that will be note 4 if we are following the order well. So we bring per trial balance for the parent, or first we just bring the parent group retained earnings or the parent's retained earnings. Then we'll bring share of profit. Now the share of profit we bring here is from the SAP. Then share of profit from an associate. If we had an associate also, their profits will come. Any impairment during the year is an expenses, we subtract it. If the parent was the one who sold to the subsidiary and there was an unrealized profit, remember what I told you here, GRE. So provision for realized profit, where the parent sold to the staff, we will subtract it. Then any other thing that happens in the question, it could be revaluation by the parent. It could be whatever. It could be they are having investment property or some financial instruments and the value has increased or has decreased. Whatever it is, you deal with it there.
So when there is a share of profit and that one it was the staff that sold.
Relax. There is a share of profit and who?
Post this one. A share of profit.
Yeah.
And that one it was the staff that sold to the parent. Now when you've taken effect, the provision for realized profit has already been taken. Yes,
so the growth you will be calculating, that's the figure you pick because you've already taken care of.
That means
the unrealized
need for this.
No. So if the subsidiary was the one selling to the parent, then the parent will not have the PUP here. Parent will not have the PUP. That's it about GRE. The last thing is about NCI. Non-controlling interest. Very simple. To calculate non-controlling interest, we will just bring the fair value of non-controlling interest at acquisition. Then we will bring share of profit of the SAP. Then we'll get a value. That's all. That's all about NCI. No thinking, no hard work, no brain. Very simple, like that. Any question?
Dividend.
Well, dividend about?
Pre
Pre-acquisition and what?
Post-acquisition dividend or something. Something about dividend. What? Declared and about to declare or something. Something about dividend. Where the parents will declare.
If the parent declares a dividend, then it has been paid, they will be subtracting, then that will be paid to our shareholders. Right? So the dividend will be subtracted from our retained earnings because we pay dividend from retained earnings.
Even if they are paying, if it's a SAP paying.
Okay, if the SAP is the one paying the dividend, paying the dividend to who? To us?
Yeah.
Yeah, if it's paying the dividend to us, that will be another matter because that will not come here. Here, what is coming here is the share of profit. Are you getting the idea?
Yeah.
If they are paying the dividend, they are paying the dividends to the NCI, and that will be, if we receive the dividend, that's a cash item. So share of profit means how much we are supposed to have received. Then how much did we actually receive? Then we'll see how much is outstanding. Are you getting the idea? So share of profit means that's the money we are supposed to receive. But if we receive a dividend less than that, then the difference will be the one outstanding. But you know, parents and staff, they are not supposed to owe anybody, so it will be cancelled out. So as the subsidiary will be having dividend outstanding to be paid to the parent is also having dividend receivable from the staff. We cancel it out like the way we do with the trade payables and the trade receivables. So we cancel it out.
That's okay. But there was this question I saw that the dividend was subtracted from the cost of investment. I don't know that.
Cost of investment. The dividend paid was subtracted from cost of investment. How? What kind of thing was that? Was it an associate or a subsidiary?
Maybe it was an associate.
Even if it's an associate, share of profit, and you can see it here. Yes, we will subtract it from here. It's true. It's true. Because this is the share of our profit. We add it to the NCI at acquisition, right? Then any dividend we receive, we need to subtract it from it so that we will not get the value of our investment in the associate company. So share of dividend will be subtracted here. Yes. I said if the parent is the one selling, then we will bring it in. But if the sub is the one selling, you're dealing with it in the net assets. So this is our consolidated financial statement. Consolidated financial statement. Now, aside consolidation, you're going to have a single entity financial statement. Certainly. Either you are preparing income statement and balance sheet, or you are preparing what? A cash flow statement. That is also another area that the examiner is going to search questions on. To be successful in cash flow or income statement or balance sheet, it means you should understand your accounting standards. Because there, the notes to the accounts that you're going to be having there, it's about treatment of various what? Items. So single entity, you should know how to deal with revaluation of assets, IAS 16. You should know how to deal with tax. You should know how to deal with a loan. Now remember, sometimes the examiner can say a company sold goods to another company, but they have a right to repurchase the goods back at a premium of whatever. That means the goods is actually what? A collateral facility they use. So this is not a sale, it's rather what? A loan. In that case, that sales figure, which was already included in the revenue of the company, we have to subtract it because it is a loan and not a sale in relation to that. So that is something that examiner. So the notes to the account is your treatment in relation to that. Then about cash flow also, you have to understand these workings. Because funny enough, when you go to cash flow, all of these workings run through that. Where you are preparing cash flow from the operating perspective, and then investment, and then financing. Operating has to do with the day-to-day running of the organization. Investment has to do with acquisition and disposal of assets, and financing has to do with how the business is financed, looking at debts, issue, and redemption, and then share issue and repurchases. So these are the things also that you need to understand about single entity financial statement. What is going to be happening here is your workings. Very, very important. And it goes back to the accounting standards. If you are strong in your accounting standard, then you can be able to do the workings that needed to be done in order for you to be able to prepare the financial statement.
The cash flow, cash doesn't come or depends on cash.
The
Cash flow.
It comes at the latter end. When you get net decrease or increase in cash and cash equivalent, then you bring cash and cash equivalent at the start of the year. Then that will give you the cash and cash equivalent at the end of the year. Do you understand? When you bring cash flow from operating activities, you get a total. Cash flow from financing activities, you get a total. Cash flow from investing activity, financing activity, you get a total. The three gives you the net increase. If it is positive, it's called net increase. If it is negative, it's called net decrease. Now the cash and cash equivalent at the start of the year. So the cash balance in the book of the company will be added to that figure, and then you get a cash balance at the end of the year. So the cash and cash equivalents include both bank balance and cash balance. Yes? Any other questions, please? Order. Why break? Why break? One also where I see you. Yes, any questions, please? Any questions? Any questions? So your standards, 20 marks. Your consolidation, 20 marks. Your single entity, 20 marks. I won't talk about this conceptual framework and regulatory framework. Go and read it. There is a question on that coming. So conceptual framework and regulatory framework. Definitely the examiner is going to examine you on it. Conceptual and regulatory. Then the issue about interpretation of financial statements. And I know the two of you have an understanding of that because you did that yesterday, and I've done that with you also about how we interpret ratios. Because remember, interpretation of ratios is a very key aspect. Now, if you are watching online, go and watch the video again on interpretation of financial statement because it's a very important area. Make sure you understand how we interpret profitability ratios, liquidity ratios, efficiency ratios, investment ratio, and all of those things there. Then we come to the final aspect called specialized accounting. This is where we talk about partnership, hire purchase, and what? Branch accounting. Partnership, hire purchase, and branch accounting. This semester, we expect the examiner to set questions either on partnership or on hire purchase. Partnership because partnership has been his area for November examination sittings. Hire purchase because he has never set any questions on hire purchase. He just brought a theory question last 2 semesters on hire purchase. That's the difference between hire purchase and credit sales. That was the theory question. But the calculation question on hire purchase, he has not brought it yet. So either a partnership question or a hire purchase question in relation to that. So these are the kind of things that you need to understand about the FR. So if you look at it, if you book your consolidation 20, Single entity 20. Standards 20. Ratios 15. That is 75%. Conceptual framework and regulatory framework. That could be 10 marks area, making 85. So the 15 mark, which is on those three guys, that we don't even know where to go, but we have to focus on partnership and high purchase. This is 85. At least, if you are generous enough to the examiner, you don't give up to 30% to the examiner. At least you should be able to pass. Are you getting it? Yeah? What happened to the high pitches? We didn't solve the question. Last week. We only did the partnership. Oh. Then we will know it during the discussion session. Because I'll solve that question with you. When? What we are doing? What's the timetable? That's next week. That is next week Tuesday.
Evening.
2 to 5.
That's the.
That afternoon.
The mock discussion.
Yeah.
What is 3 to 5?
Mock discussion.
Is that?
Yeah, I'll go to it.
Mock discussion. And I won't buy it. Yes, now.
2 to 5.
That you want to only.
So there is another session